Stocks look like they're ready to continue the rally this morning. No disruptions after a CPI update. Bonds and the dollar a little changed. Joining us, Loreen Gilbert is the CEO at Wealthwise Financial. Loreen, welcome back to the Schwab Network.
Thank you.
All right, so we've had a pretty quiet week in terms of news flow. Next week we get inflation. Markets keep grinding higher here. Is there anything that can get in our way?
Well, I think we're seeing a good earnings season with 2/3 of the S&P reported right now, and 70% have beat earnings expectation, which is above the 10-year average of 63%. So we're seeing some positive news on earnings, and really it's all been about guidance. So I think that anything that could disrupt where we are would be either no guidance from companies or very little guidance. And that's really what we've been seeing, right? As we don't hear positive guidance, that's where stocks get hit.
Yeah, it seems like the market's pretty clear about what it wants, what it doesn't want right now. And it wants margin improvement. It wants enhanced profitability. Is that just kind of the new normal here, post-COVID, post-zero interest rates?
Well, definitely, profit margins are important. And so what we've seen so far is 11% year over year on those profit margins, which is fine. It's gone down a little bit from 11.2 to 11% year over year, but it's not 10%. So we still have a healthy market. We still have healthy companies, and that's what we need to see to continue the stock market moving in that bullish direction.
One of the things you've been looking at in earnings is the difference between pure domestic plays, the companies that are more on the international side. Of course, you're going to get the Mag 7 in there. Small caps have really struggled. They generally tend to be domestic. What's with that divergence?
Yeah, so we have seen a divergence between companies that generate their revenue internationally versus domestically. And so we've seen it internationally do quite well. But where we're tracking is with the dollar resuming its strength, we may see a reversal there. So I think we just need to watch the dollar. We have seen communication services do quite well, come off their lows, and we see quite a bit of strength in both communication services as well as technology. So I think, continuing to look at those companies as they are outperforming.
What stands out to you? What should be in the portfolio right now? Is it big tech and the skew that's in the indexes? That's something we should be on board with, Loreen?
I definitely think we have to be invested. Large cap growth is an area you cannot ignore, and we have an overweight in semiconductors as we like that area of the market. The other area is small caps, which, as you mentioned before, has struggled, and yet we see that as a great opportunity with a huge divergence in performance between S&P 500 and Russell 2000. So when we look at that and we're looking for value, we're looking at the small cap area of the market.
What needs to happen to get them off the mat? When's the bounce coming for small caps? What's going to be the cause, or how long do you think we need to wait to see that group kick into gear?
Yeah, well, our expectation is for 5 rate cuts this year, and that would be the catalyst for small cap. Most definitely. It makes it easier for smaller companies to get financing. Lower interest rates definitely help small cap stocks. So as we see rates coming down, we see that as a boost for your small caps, and we want to be in it now. We want to have that overweight now before we see that rally.
All right. Cuts versus growth. Which would you rather have for small caps? If I said we're going to cut 6 times, but our GDP is going to slow, or we're only going to cut 3 times or 2, but we're going to see GDP hanging out at this 4%-ish area, what would you prefer?
Well, I'd rather the cuts for sure. I'd rather see the Fed cutting rates. I think that's going to help across the board and give the markets overall that needed catalyst to move forward. So we have a healthy GDP. Those numbers are fine. They're not going to go in the tank. So I think that given what we see right now, we'd prefer to see the rate cuts.
All right. Love the transparency of the need for cuts, right? I mean, at the end of the day, these are companies that in the small cap universe, they need some pretty cheap financing. It seems like they really are dependent on having costs come down for their debt burden and a little bit more time for them to turn profitability. I mean, it's kind of a lower quality trade, I guess, is one way to put it.
We still like high quality across the board, definitely. And when you think about fixed income, we're definitely in the high quality space. We do see that companies that are not as high quality have extended themselves on the debt side. And so I think what we definitely want to see is high quality for sure in fixed income.
Okay, so even when we shift down the market cap scale, we have to still try and retain the qualities of good
Quality and
financial
profitability.
characteristics.
Yeah. So even looking at small cap, looking to see that those companies are profitable.
So is it a stock specific type of investment then, instead of just buying a big index, instead of just buying the pure Russell then? Are there funds or active management choices that have to go into that?
Yeah, I definitely think it is a stock picker's market right now, not an index market. I would say that across the board, across the capitalization structure, we're looking at specific names. We're looking at active management, not a passive management style.
Hey, Loreen, one more thing for you that's on the calendar. Of course, the election coming in November. The chit chat is already building. Twitter timeline's already getting kind of insufferable. How do we manage that as investors?
Well, I think investors need to keep their politics out of their portfolios because that doesn't tend to work that well. What I will say is election years tend to be good years for the market. We don't expect this year to be any different. So we do think that between now and the end of the year, we end higher in the markets. That's not going to be a straight line, but focus on the end game. So we would look at the end of the year versus now being
All right.
higher.
Great stuff, Loreen. Good conversation. A lot of good details in there. Appreciate the help.
Thanks so much.
Sure thing. Good chat. Loreen Gilbert, CEO at WealthWise Financial.